everybody? It's your boy Sean McLaughlin at Options Sean on the old Twitter X. Today is Wednesday, December 24, 2025. It's Christmas Eve. You wouldn't know it where I live. It's like 65 degrees outside. It's beautiful. Feels like a nice spring day. I just had the dogs out for a walk and I can't believe how nice it is. Anyway, um, welcome. This is the What Are My Options show. This is a free for all show where it's really just kind of like an office hours. You could ask me questions about options, about strategies, about mindset, about trades you're thinking about putting on or trades you're looking to help get repaired. Um, any and everything related to options. If you have a question, throw it into the YouTube chat feature there, and I will see it, and we will get into it. Before we do that, let's just, I couldn't help but notice the S&P 500 as measured by the SPY. If it closes here, this will be a new closing high for the year. It's always great to go into Christmas with the market at all-time highs. That's not the case with the Qs. They're off the highs. They still have some repair to do, but um, finishing the week strong, which is nice. But really, what I want to bring to your attention, guys, before we start digging into questions, and I threw this into the All Star Options chat room this morning. Um, Something with the Russell 2000 has caught my attention. I noticed that the implied volatility in the Russell is at the lowest ranking of all of the ETFs that I track. I track like, I don't know, 35 ETFs or something like that. And IWM was dead last. And this will actually show up in a different chart here. Let me bring this chart up. Here's the IWM chart with the implied volatility chart here at the bottom of my screen. See this blue line here? This is implied volatility, which measures more or less the expensiveness or cheapness of options. All right. And look at the way this chart, I mean, this is all year, right? But look where it is right now. It is at the lowest level that it's been since February of last year. Okay. And I want to point out on February 13th, which is when it looked like it hit the low here, February 13th was right here. Russell was kind of sitting right up against the 50 period moving average, not doing much. But look what happened in the weeks following, right? We had a big collapse. Russell went from 230 is down to almost 170. That was a big move in Russell. Now, just because volatility is low does not mean that a range expansion is just about to happen. All right. It's more likely when volatility is high, like it was here in April, when volatility is high, it's much more likely to mean revert and come back down, usually in short order, than it is for volatility to pop from being low. All right. So I don't want to set the intention or the assumption that just because volatility is low, that we need to bet on an expansion of volatility or a rise of volatility. However, when volatility is low, you can get positioned at cheap prices to bet on a range expansion. And if you get it right, you can get paid incredibly handsomely. Okay, so that's something to think about. And so when I looked at volatility as it is right now, I said, man, if I think that the market's going to have some moves coming into the new year, right? I could probably get positioned pretty cheaply in either direction, whether we have a big move up or a big move down, get positioned in attractive prices and give myself a high likelihood of winning. And so I threw an idea into my chat room and said, hey, this would be a good time to buy either strangles or buy an iron condor, which is not something we normally do. So a strangle, for those of you who don't know, a strangle is an options position where you buy an out of the money call and you also purchase an out of the money put. A long strangle, so you're long both contracts and you're basically betting on a big move in either direction. You don't care which way it goes, as long as it goes one way and goes one way far, then you'll make a ton of money on one option and the other one will expire worthless, and that's okay because you'll make more than enough on the other to make up for it. Now, many of you are familiar with iron condors, right? Traditionally, 99% of the people who put on iron condors, I made that number up. I don't know if it's 99%, but it's probably pretty close. Most people who put iron condors on, that's a delta neutral short credit spread trade where you're betting on sideways action. You're betting on the market to stay within a range, and you're short a call, you're short a put, but you're also long a call, long a put against it to define your risk. But you're just betting on sideways action, and you're betting on the premium that you collected when you put that iron condor on. You're betting on that premium just kind of melting away, and you'll buy it back for cheaper than you sold it for, realizing your profit. Well, what if we flip that on its head and did the opposite and did a long iron condor? So that's what I want to kind of show to you guys today. Let's go to the analyze tab here. I've mocked up here a potential long iron condor trade in the IWM. So I selected the 240 puts on the down. This is, by the way, I looked at April. So that gives us 4 months for this trade to play out. Okay. I was looking at the 240 puts to get long and the 280, the 275 calls to get long. I chose those strikes because if we look at the options chain here, they have roughly 30 delta, right? Ideally I was going to do 25, but we just did 30 delta. Okay. And then I sold the calls and the puts, or I haven't done the trade yet, but I'm thinking about it. I'm thinking about selling the calls and puts that are $10 away from the long strikes to improve my odds of success, right? Now, when volatility is cheap, you could just keep it simple and just buy the 240 puts and the 275 calls and have the potential for unlimited upside in either direction. And there's nothing wrong with that at all. Nothing wrong with that. In fact, maybe that's the better trade here. But I thought I'd do it as an iron condor. It's a little bit cheaper, right? So a trade like this right now, I could probably put on for about $3.72. You can kind of see here at the bottom of my chart, it would cost me roughly $3.72 if I did this with one lots, right? And that's the most I could lose, all right? If IWM continues to stay in this range between 240 and 275, which if we pull up the chart here, 240 is right here, 275 is up here. I mean, yeah, it could absolutely stay within that range. And if it does, I could potentially lose all of the premium that I paid for this trade today, 372. All right. Now, if it goes my way, if it collapses or if it rises dramatically, I'm going to win, but my gains are capped, right? My gains are capped because that's the trade-off I made by lowering my upfront risk, right? Like just comparison's sake, let's say we did just the naked strangle here. So let's do this. Analyze a strangle. So the 240, wait, what's going on here? Let's do this. The 240, analyze a strangle. 240 on the puts and the, what was it? The 275s on the calls. So let's get that lined up here. Sorry, this is clunky here. It doesn't make for great live TV. But okay. So if I just did this strangle, it would cost me about $9.25, $9.29. And here's what that P&L graph would look like. This is what a long strangle looks like. It's got unlimited upside in either direction, right? There's no cap to how much that trade can make, right? But it would cost me $9.30, more than double what the long iron condor would cost. Nothing wrong with that. That doesn't make it a better trade or a worse trade. It just means that's what your risk is. You're risking more to potentially make more, which is great, right? That's how it's supposed to work. If there's a potential for more money, it's going to cost more money, or you're going to have much, much lower odds of success. All right. So I'm choosing, I think, the iron condor just because it's less money to risk. Okay. It's only 360, 372, and my gains are capped. But what I would do, how I would manage this trade if I put this on is I would put out a good till cancel order on both the put spread. So this is really two spreads, right? It's one spread, the iron condor, but it's composed of two vertical spreads, right? I'm long the 240 puts and short the 230 puts, and I'm long the 275 calls and short the 285 calls. Those are two separate vertical spreads. So what I would do if I had this trade on, I would put out two good till cancel orders to close each side of this spread at a profit. I'm only going to get one of them. It's very unlikely I would get both. If one hits, the other one won't. But I would put an order out to sell one of these spreads or each of these spreads for $8 each, right? So put a put spread or put a limit order out to sell the put spread for $8 and also put out a limit order to sell the call spread at $8. Good till cancel. Now, why $8? I've talked about this before. The most either side of that spread could be worth is $10. That's the difference between the strikes. So the 240 put that I'm long and the 230 put that I'm short, that difference is $10. That's the most that spread can be worth, right? I don't like holding on for those last nickels and dimes in a spread where I've already captured most of the premium. I subscribe to the 80-20 rule, right? When I've achieved 80% of the maximum potential value of a spread, that's when I tend to look to take things off, because at that point I'm risking $8 to make an additional two. I don't like that math. Okay. So I would put out an order to sell either of these spreads at $8, either the put spread or the call spread, and then just let them hang out there good till cancel. And if we get a move in IWM, one of those might get hit and I'll walk away a winner, right? Again, I'm paying $372 for this entire spread right now. If I could sell one side of it for $8, boom, I'm a winner. I've doubled my money, more than doubled my money. On the flip side on this trade, if IWM continues doing nothing and continues mucking around in this range, I won't just hold this thing all the way to expiration and let it expire worthless. I will put a stop loss on it based on the price of the spread, right? So if I paid $372 for it, once I'm down about 50%, so if the spread's now worth about what's that math? About $1.85. If the spread starts trading around $1.85, I'd probably close it there. Just take my loss and move on, right? Down 50%, I'm out. But I just wanted to bring this trade up to you guys because, man, when you look at the implied volatility in IWM, it's so, so low. And it feels weird to me to have volatility in an index like this be so low heading into a new year when, I don't know, I've seen big moves happen early in a year. I've seen big moves up. I've seen big moves down. New money comes in, new stuff happens, who knows? So it's a compelling idea. It's not a trade I've put on yet. I might put it on for All-Star Options subscribers. We'll see, but just want to throw that out there because it's Christmas. I'm giving you ideas. All right. Let me look into the chat here and see if I have any questions. I see some Merry Christmas from you, Hot Pepper. Thank you. Same to you, Steven, my man. Dude, let's hang. Come hang out with me, man. Let's see. Jackson, EVR base, Schwab big base, and Tesla. Sweet. Let's check them out. EVR. Good looking base. Good looking base. You got an idea what you want to do in that, Jackson? It's on a daily chart that we're looking at here. Kind of looks a little cup and handle-ish, which I always like. If this stock got above 355, I think I could get pretty interested in this trade. Volatility's low, so as an options trader, you can keep it simple just by calls, although it is an expensive stock. So in dollar terms and actual absolute terms, the options will be expensive. Like if I'm looking at, say, March options, I mean, the at-the-money options are going to cost me about 1850 probably to get in, somewhere between 1850 and 19. It's a pretty wide spread. So, I mean, it's wide because it's expensive. It doesn't mean it's terrible, but there is not a whole lot of open interest there. Also, the stock doesn't trade a whole lot, less than 1 million shares a day on average. So maybe not the best for an options trade. I'm not sure. I mean, you could do it, but if you did, keep it simple. Just do a long call to express that bullish bet. Don't do a multi-legged spread in something that doesn't have a lot of volume. That's a good rule of thumb. Schwab, I'm definitely with you on Schwab. In fact, I have a trade on in Schwab here. I'm bullish on this. I'm long some calls here. Yeah, yeah. You have my support. I'm in it. I have some calls in Schwab. What am I long? I'm along the January 100s, right? Yeah, just a small little position there. Got 2 contracts. No big deal. No big deal. Let's see. What else here? Jackson says, IWM for January 2027 have the 300 calls already. And if this base runs, I have the 325s that are less likely to win, but can be massive. So let's bring that back up again. IWM. So you got till January 2027. So you have a whole nother year and you're long the 300 calls. I mean, I don't know when you got them and what you paid for them, but I mean, that's the other thing too. When volatility is this cheap as we're seeing here on this chart, this is a great time if you, especially if you have a thesis, if you have a bullish thesis or a bearish thesis, whatever your thesis is, if you have a directional thesis, when volatility is cheap like this is a great time to position longer term because volatility is going to be cheap. And the further you go out, the cheaper it gets in many cases. In fact, let's look at that. I'll bring up the options chain here. Um, it's kind of hard to track, but if you notice on the right hand side of my screen, you see these percentages. This is the IV implied volatility at each of these expirations. And so like the front month, which is January, has the 18% implied volatility. But if we go to January, let's see, 2027 is what your buddy here's talking about. That implied volatility, that implied volatility is 24. Huh. Actually is higher than the current January, which is 18. Interesting. Regardless, I mean, usually, and I shouldn't say usually, but often you'll see further dated options be a little bit cheaper in terms of volatility. But when volatility just overall is cheap, it's still a great time to position long term. So if you're bullish, and it sounds like you are, Jackson, holding some longer dated calls to express your bullish thesis right now can be a great idea. Let's see. Richard says, I assume you're talking about the IWM. Says, why not do a bull call or a bear put spread or a bull put or a bear call? Just interested in your reason not to do one of them. Well, that's a lot of different spreads there. You got the bull call. Oh, so why wouldn't I just do one or the other? With the IWM, I wanted to do something delta neutral because I don't know if we're going to have a big rise or a big fall. I don't know. So I'd rather just position for both, and all I need to do is get one of them right, and we can make money, right? Yeah, I'm playing for a range expansion. I'm not playing for a directional bet. I'm not thinking that IWM is going higher or IWM is going lower. In this case, I'm just playing for a range expansion. Okay. You looking at silver futures like in the USA miners? I mean, yeah, silver's been going crazy. Hecla mining has been a big move. I've been playing that. I'm in it. I'm in it right now, although I may get out soon. Let's see. CDE, I'm not in this one. I don't know how you say that. Core mining. Core mining. This one looks interesting. You know, if it got above, if it got around 20 bucks, it got to 20, I might buy it. You know, guys, one thing you should know about me is, if this isn't obvious already, if you've been watching me for a long time or paying attention to my stuff, I'm a breakout trader. I'm a trend follower. I have no problem buying things making highs, right? That's my style. That style's not for everybody. In fact, I solicited a lot of feedback from my customers and my readers these last 2 weeks, and I've gotten a lot of feedback from a lot of people. It's wonderful, wonderful. And a number of people said, how come you don't buy stocks when they, pull back to their 50 period moving average or their 200-day moving average? You know, how come you don't buy, playing for bounce backs to highs and things like that? And the short answer is I have no problem with those types of strategies. That's just not my bread and butter. I'm a breakout trader. I like to buy stocks that are breaking out. I like to jump on a trend, right? I don't want to be trying to catch a falling knife. I don't want to sit and wait for something to develop. Generally, uh, I'm looking to catch the ride when it's in motion, right? I'm not going to buy the low, and I'm not trying to sell the top. I'm trying to catch the meat in the middle. That's what a trend following trader does. So I'm consider myself a breakout trader, a trend following trader, and and a ticker like this CDE, maybe buying it right here is good opportunity to get it on a little discount, but I will much prefer waiting till it got to 20 and proved itself to me, and then I would get in. Okay, let's see. What else we got here? Adusami. I don't know what your handle is, but he says he's wondering how I would play Melly, Mercado Libre, as they say. How would I play it for a long? Well, this kind of follows right on the conversation that I just had of I don't like buying stocks that are not going in the direction I want them to. So if I'm looking at this chart right here, for me, this is a no play for now. It's a no play for now. Sure, this might be the bottom and this might be a good place to play for a rebound if you're that type of trader. I am not. That's not me. You can see actually I have a an alert here set on my chart here, just to let me know if it gets to that level around 2,500. If it got up to 2,500, I'd get interested. And you know, some of you might be like, well, that's crazy. You're missing out on all this profit from 2,000 up to 2,500. Yes, I am. Yes, I am. Because if I'm going to be playing it, I'm going to be playing it for a breakout to fresh all-time highs. I like stocks. My dream scenario for any trade that I put on, and I've talked about this many times, my favorite stock or my favorite setup in the world to buy is like, as I love to buy calls in a stock making fresh all-time highs. Like the first all-time highs it's made in a while, right? Not if it's been making all-time highs every day for the last 3 months and then I'm like, oh, it's another new all-time high today. I'm going to buy it. No, 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 not like that. I mean a fresh new all-time high, right? So like if this Mercado Libre, I don't know if that's the all-time high there, 26.45. Let's just assume it is, okay? If it broke 26.45, that's when I want to get interested because when it gets above that level, when it's a stock's making all-time highs, and again, I'm repeating myself to some of you and I apologize, but for others who haven't heard this, you need to hear this. When a stock is making all-time highs, a number of things are true. Every single person who owns that stock, regardless of what price they paid for it and regardless of when they bought it, at that point, when a stock makes an all-time high, every one of those holders is making money. Every single one. Okay. Some more than others, but everyone's winning. And when traders are winning, generally speaking, they're not in a hurry to sell. At least not me, right? When I'm winning, I think I can win more, right? So generally, I'm not in a hurry to sell. So there's no selling pressure, very little selling pressure from people who are long the stock. On the flip side, anyone who is unfortunately holding a short position in that stock when it makes an all-time high, regardless of what price they sold it at, regardless of when they sold it, they are losing money. And every tick higher means not only are they losing more money, but the position is getting bigger as a percentage of their total portfolio. Short holders don't like that math. And so if you're short, the only way you can get that pain to end is to buy the stock. And so a stock making all-time highs has long holders who are not interested in selling, and it has short holders who need to buy to cover to stop the pain. So a stock making all-time highs has no upside resistance. It's got nothing but clear skies, nothing but blue skies, and willing and motivated buyers to stop the loss in their losing shorts and winners who want to add to their winning position. So I love stocks making all-time highs. Those are my favorite stocks to buy. I love buying calls in stocks making all-time highs because also as an options trader, what also tends to happen is a stock making an all-time high, nobody's scared. Maybe the short holders are scared, but generally speaking, nobody's scared. And when nobody's scared, implied volatility, meaning the premiums and options come down because no one's getting too aggressive in either direction because nobody's scared, nobody's worried, nobody's concerned about the next shoe to drop or anything like that. So typically speaking, this is not always the case, of course, but typically speaking, when a stock is at all-time highs, you'll find low implied volatility as well. Now that's not true if it's like a meme stock or if it's like some hot uh, uh, some hot sector, right? You might see some high implied volatility at all-time highs, and that's okay. But often you won't. Often you'll see implied volatility being very low. So buying calls can be very cheap. And like we were talking before, when volatility is cheap, you can position many months out, giving you even better odds of success because you just have time on your side. So sorry, I got off track there on this Melly, but no, Melly's not a buy for me. I would not position long in this stock. Um, I don't like it. But gun to my head, if I were to position long, probably long calls because volatility is cheap. Although this is a very expensive stock, $2,000 a share. So just to cut the premium cost on something like this, I would probably play it in a bull call spread. I would buy slightly out of the money calls and sell some further out of the money calls against it just to lower the cost. Because I mean, look at this. I mean, let's open up the options chain. Like if we just look at January options that expire in under a month, the at the money calls are going to cost you. They're going to cost you $6,000 minimum just to buy one contract. That's a lot of cheese for one contract. So, gun to my head, if I were to do that, I would probably put on a bull call spread. All right, let's see what else do I have here in the chat. Silver going way higher. I mean, yeah, I mean, geez, let's pull up that silver chart. Let's look at that real quick. Silver chart is just unbelievable. I mean, this is true for all metals, but I mean, going back to May, this thing was trading at 30 bucks. It's already more than doubled. Whew, what a run. What a run in silver. All right, someone brought up the Take Two Iron Condor. Is this a good candidate for an Iron Condor? It's not a terrible candidate. It's not a great candidate, and I'll tell you why. It's not a terrible candidate because the stock does appear to be kind of stuck in this range between 230 on the low side and the all-time highs there at 264, right? You do have a range you could lean against. Maybe you sell the 230 puts and you sell the 265 calls, right? So you do have a range. That's the good news. The bad news is that the implied volatility is not that high, so you're not going to get a whole lot of premium for that spread. Ideally, and maybe I would have lost, but ideally I would have sold an Iron Condor back here back in early November when implied volatility was much higher, you see. But we did have a crack. I believe that, yeah, this was earnings related. So depending on where I was positioned, I might have gotten stopped out. This might have, I mean, I might have gotten stopped out, and then today I'd be kicking myself because it's come back. I'm like, oh, look at that. If I would have just held, I would have made money. But risk management is job number one. Yeah, I mean, look, I don't hate it. If you wanted to put an Iron Condor in now, I don't hate it because of the range. You have a range that supports the idea. I just don't think you'll get a whole lot of premium for it because the volatility is low. All right. Well, look, guys, it's been 30 minutes, and unless you guys have any more questions for me, maybe we'll just wrap it up. The market actually closes here today in 30 minutes. I didn't even know that the market had a half day today until about 30 minutes into the trading day when I saw somebody mention it. I was like, oh, wait. Oh, yeah, we have a half day. I'm always the last person to know on these things. I really am. But it makes sense. It's Christmas Eve. So, hey, happy holidays to those of you who celebrate these holidays. I hope you have a wonderful time with your family. Enjoy the day off tomorrow. Friday is a full trading day, but I don't know how much is going to get done on Friday. Maybe I'll put a couple trades on. We'll see. I'll be around. But thanks for tuning in to What Are My Options. We will do it again next Wednesday, next week. And the All-Star Options Jam session that usually happens on Thursdays, well, due to the holidays the next 2 weeks, we're going to be doing them on Fridays the next 2 weeks. So we're going to be doing it at 11 Eastern tomorrow. I believe we'll do the same time the following week. I haven't confirmed that with my team yet, but we should. All right, everybody, be well, trade well, happy holidays, rest up. It's going to be a great new year next year. We're going to be ready. All right, take care, everybody. See ya.